Good morning, students. Welcome back to the session on audit. We have been discussing NBFCs and we'll continue our discussion on audit of NBFCs today. And we also plan to start insurance, that is about audit of insurance companies also today after we complete this NBFC. So in the last session, we have discussed about the various regulatory requirements applicable on NBFCs in terms of various provisioning requirements, certain prudential norms, in terms of classifications of assets of NBFCs. As around all of these regulatory requirements or the understanding of NBFC, as we have discussed, it's important for the auditor because until unless the auditor will not know all these legal requirements relating to the NBFC, the audit procedures that the auditor will have to design will not be up to the mark. So that's why it's very, very important for the auditor to have thorough understanding of all of these requirements. Secondly, NBFC is also such wherein the legal or these regulatory requirements are significantly higher as compared to any other entity. And that's where the focus on the compliances part, or we can say the risk which is attached in relation to the compliance of all of these regulatory requirements in case of NBFC increases further, and accordingly all of these points are required to be taken care of. So now we will move on to a checklist wherein we will try to understand how the audit of a particular type of NBFC should be conducted, what all audit procedures should be performed or may be performed in relation to a particular type of NBFC. Though we have been discussing these procedures in respect of an NBFC, as you can also see on the screen right now, this is about investment and credit company, a type of NBFC you can say. And even though there are certain specified procedures which have been listed down, which we plan to discuss, but still there can be many other procedures in relation to this type of NBFC, which will not be covered over here. So that means this list is not an exhaustive list. This is only a list which is for illustration, okay, which is only for the purposes of our understanding. So this is only illustrative in nature. Secondly, even if we look at all of these procedures, still there could be some additional procedures, plus there could be certain procedures that we are going to discuss which may not be applicable to a particular type of NBFC. And depending on the type of NBFC that we'll have, all of these audit procedures may change. So that's why in the examination, if you are asked any sort of question which is around the audit procedures, you need to just remember the basic process of audit. And with the help of that basic understanding of audit, the basic procedures, the conceptual understanding around audit, you will be able to structure various types of audit procedures. And this checklist, therefore, is not really required to be learned by you. Okay, let's understand all of these procedures and then we'll get back to this aspect, whether we should really learn all of these procedures or maybe we can just design all of these audit procedures on our own. Okay. So first, it says physically verify all the shares and securities which are held by NBFC. Where any security is lodged with an institution or a bank, a certificate from the bank to that effect must be verified. Now, as you can see, though we are starting with this checklist, but the start which any audit procedure or any audit will require is all about planning. So that means the procedures over here are not really limited to planning. Those are also about the substantive testing, about analytical testing, whole lot of stuff of procedures are covered. Secondly, there is no real order as to which procedure should be performed first, and that is not required. Okay, so you can just think about an audit procedure and put it over here. Now, this procedure talks about the securities which are held by NBFC. So that means the investments of the NBFC. So wherever there are investments, and let's suppose if those investments have been mortgaged in respect of the borrowings which the NBFC may have, the advances which the NBFC might have obtained, or maybe for some other reason, those securities have been lodged with third parties. Now, who could be third parties? It could be any financial institution other than that NBFC, or it could be a bank. Then, in such a case, how would the auditor verify that? It will not be possible for the auditor to physically verify. Therefore, there are two options available. Either the auditor will go to the premises, the location of that bank or the institution which is holding the security of this NBFC, or generally that bank or that institution will provide a certificate, a confirmation that such securities of this NBFC are held by that bank or institution. Okay. Next, whether the NBFC has not advanced any loans against the security of its own shares. Now, the NBFC should not advance any loan against the security of its own shares. Now, how would we check it? In respect of various advances which are given, one procedure will be to make inquiries with the management and also to check the list of securities which would have been obtained against the advances. So there must be a detailed file which will indicate all the securities which have been obtained. So auditor can just look through all of those securities and whether anywhere in those securities own shares have been specified. So that is again one way through which the auditor will be able to verify this. Next, verify that the dividend income, wherever it is declared by a company, has been duly received by an NBFC, and interest wherever it is due except in case of NPA. Why? Because in case of an NPA, interest income will be recognized only when it is received. Further, it says NBFC has an option to account for dividend income on accrual basis if the same has been declared by the body corporate in its AGM and the right to receive the payment has been established. So it's all about a recognition of income of NBFC. We have all discussed about it. How will the auditor verify this? First of all, auditor will have to verify the assets, whether the assets against which those income is getting generated are NPAs or performing assets. Because if those are performing assets, then the income should have been recorded on accrual basis. But if the assets are non-performing, then the income will be recognized on realization basis. So this categorization would also be done by the management of the NBFC. So it's not something which is required to be done by the auditor. So the detailed computations which the management will provide will have all of this information available. It's up to the auditor then to verify that information. And some of these advances, auditor will also check with the supporting documents available with the management. Supporting documents in respect of non-performing assets would be to verify the payments, whether those have been received on time or not. So that means the first step for the auditor therefore will be to verify whether the assets are performing or non-performing with the help of those regulatory requirements. And in case those are performing or non-performing, accordingly, auditor will have to get into those computations done by the management, verify those computations of the interest received, whether the interest or any other income has been completely recorded or not. Okay. Next, income from bonds or debentures. Income from bonds or debentures of corporate bodies is to be accounted on accrual basis only if interest rate on those instruments is predetermined and interest is serviced regularly and not in arrears. Once again, it's the continuation of the same point. Next, test check bills or the contract notes received from the brokers with reference to the prices vis-a-vis stock market quotations on the respective dates. Now, in case there are any contract notes, in case there are any bills, etc. Now, in respect of those bills or the contract notes, the underlying documents will be verified. As regards the pricing which is specified therein or any other particulars related to those documents need to be supported with the supporting documents by the auditor. And this will again be done on a test check basis. Verify the minutes of board meetings for purchase and sale of investments. Ascertain from the board resolution or obtain a management certificate to the effect that investments so acquired are current or long term. Now, depending on the type of investment, it will be, means whether it will be current or long term, its accounting varies. So that's why, first of all, auditor will have to verify whether the investments are current or long term in nature as per the criteria as prescribed by accounting standard. Once this segregation is done, then of course the next step will be to verify the income which is recorded on those investments. Now, as around the criteria for this current or long term, if we go by the requirements of accounting standards, it also says that if the investments are current in nature, then those should be marked to market. Means those should be valued at market prices, market values. So therefore, in those scenarios, the management may also have recorded certain investments which are current and which have been marked to market. Now, in respect of those investments, again, the valuation may change. And to check whether the investments are held for long-term purposes or are current in nature, the board must have assessed this, board must have discussed this matter, and one of the important documents for such verification will be the minutes. And of course, beyond the minutes of the board of directors, the auditor will also have to have inquiries with the management wherever required. Next, check whether the investments have been valued in accordance with prudential norms and adequate provision for fall in market value wherever applicable have been made. Okay, so this is all about verification of the valuation of investments. Next, obtain a list of subsidiary or group companies from the management. Verify the investments made in those companies. Ascertain the basis for arriving at price paid for acquisition. Next step is about investments, but into subsidiaries or the group companies, for which if any purchase consideration has been paid during the year because the acquisition has taken place during the year, then the auditor will also have to ascertain, auditor will have to verify the basis which has been used for the valuation of those investments, because this can be another important area for the audit purposes, because as regards the valuation, there could be a big gap, and this may also have certain implications from the taxation side. Yeah, and all of these assessment would have been done by the management. Auditor needs to obtain all of those assessment and needs to verify whether the assessment done by the management is correct or not. Next, check whether the investments in unquoted debentures, bonds have not been treated as investments but as term loans or other credit facilities for the purposes of income recognition and asset classification. Now, for the purposes of income recognition or for the purposes of asset classification, if any of the assessment has been changed by the management, then this will again be verified by the auditor by having discussions with the management, by checking the supporting documents around. Next, in respect of shares or securities held through a depository, obtain a confirmation from the depository regarding the shares or securities held by it. So it's one and the same thing like we discussed for securities which are held by bank or institution, any other institution. Same way, if the depositories are holding the securities, so they will also be providing the confirmation. Verify charges received or paid in respect of securities which are lent or borrowed. Now, in respect of any charges on the securities, auditor would verify the P&L, because in the P&L, the charges received or the paid would be accounted for. And then he will have to trace whether the charges which are applicable, those have been accounted for completely or not. And if those have been accounted for, what's the amount at which they have been recorded. Obtain a certificate or obtain a confirmation from the approved intermediary regarding securities deposited. So this is another confirmation which he will obtain in respect of securities deposited with or borrowed from any approved intermediary. So again, it's about a third party confirmation that he will have to obtain. Now please understand that in respect of an NBFC, such type of documents, whether we are talking about securities or whether we are talking about any of the instruments which are held by third parties, these could be numerous. So it's not that the auditor will obtain the confirmation for each and every document. Generally, there's a list which will go to a third party that these are the documents which are held with you. So third party will confirm that list, that entire list on a single document, on a single piece of paper, and that becomes the confirmation for the audit. Okay, so it's not that for each and every type of instrument, for each and every type of document, separate confirmation is required. Okay, next, an auditor should examine whether each loan or advance has been properly sanctioned. He should verify the conditions attached to the sanction of each loan or advance, limit on the borrowings, nature of security, interest, terms of repayment, etc. Now, this happens to be one of the most important procedure for audit of NBFCs, because this is all about loans or advances. As we have discussed that in case of an NBFC, loans or advances are significant part of the balance sheet, and therefore any income which gets generated from such loans or advances happens to be the most significant component of the P&L of the NBFC. Therefore, in respect of loans or advances, a significant time is spent by the auditor. The focus of the auditor in case of financial institutions audit would always be on these advances, because these advances may have a significant impact in terms of the presentation of the financial statements, in terms of various prudential norms which the NBFC would be required to ensure as per the regulatory requirements. So let's try to understand what could be the various procedures in respect of loans or advances. First, as around the loans advances which are given to various customers, NBFC will have certain regulatory requirements. On the basis of those regulatory requirements, NBFC will also structure its own policies and procedures. Means, if a loan has been given to a customer, then following set of documents should have been received from that customer. Number one, there would be certain categories of the customers to whom loan or advance would not be given by the NBFC as per the policies and procedures of the NBFC. If any loan or advance has been given to a customer and who happens to be, let's suppose, a defaulter, say in respect of any other credit facility given by NBFC to such customer. Now, as a consequence of this, all the credit facilities which would be given by NBFC to such customer will become NPA. So this is another area which will have to be verified by the auditor. In the balance sheet of an NBFC, the quantum of advances may be very, very high, because if we talk about large NBFCs, they may have thousands of advances which are given to customers, and these may be changing. So there could be hundreds of advances which were paid during the year and which were repaid, because those were short term in nature. And there could be various other advances which have been continuing year on year. So that's why here again, even though this area happens to be the most significant area for the audit of the, I would say, balance sheet of the NBFC, still it's not something which will be checked on 100% basis. This area once again will be verified by the auditor on a test check basis. Now there are certain criteria which the auditor can use as regards this sample testing. First, the materiality. On the basis of the materiality, auditor would want to choose and identify which all advances he would verify. Secondly, the number of samples once again will be determined by the auditor on the basis of materiality, or on the basis of his risk assessment or his judgment or his past experiences. Next, as around the types of advances, an NBFC may have different types of advances. One may be a car loan, one may be a home loan, or one may be any other purpose loan which have been given. So the auditor may want to verify each and every type of loan which has been given. Now, as around the loan which are given, there would again be various categories. The loans which may be for high risk customers, the loans which may be for low risk customers, the loans which may be for medium risk customers. So there are various criteria which are used for the purposes of selection of the samples, basis which the loans or advances will be test checked. So this area therefore is very important. Secondly, this area is a significant risk area generally for the auditor, and that's why whenever any loan or advance has been given, so what is the policy procedure, what are the prerequisites for advancing, for giving any advance or for giving any loan. But let's suppose if the loan has been given, certain documents are required to be provided by the customers. So whether all of those documents were received by the NBFC or not. Many a times, some documents are received by the NBFC even after the loan is given, even after the advances are given. So in respect of those documents, what is the policy of the NBFC? By what time those documents are required to be received, and whether all of those documents which are required to be received have been received or not. Okay, all of these things are very important for the auditor, because most of these things would help the auditor in assessment of whether a loan or advance should be classified as NPA or not. Because the risk assessment of the customer, which the NBFC would have done. So I'm not talking about the risk assessment from the perspective of audit. I'm talking about the risk assessment of the customer. Because on the basis of the risk assessment, NBFC will charge interest from the customer. NBFC will require various securities from the customer, and basis which NBFC will be secured as around the loans or advances which are given. So that's why this is a very critical area in case of audit. So whenever you are required to list down the procedures related to audit of any type of NBFC, just make sure that you are not missing out on this audit procedure, because this is the most important audit procedure for any NBFC. Next, obtain the balance confirmations from the concerned parties. Now this is about the loans or advances which have been given. Now similar to the balance confirmations which are required to be rolled out. You remember the balance confirmations which are required to be rolled out. We discussed about external confirmations in relation to debtors, in relation to banks, in relation to various other items in case of companies when we were discussing about auditing standards. So it is similar to that. Now the balance confirmations are required to be obtained from those parties to whom advances have been given. Okay, and this procedure would be similar to those requirements of external confirmations that we have discussed earlier. It's just that now instead of debtors, we have certain parties to whom loans or advances have been given. Otherwise, most of those requirements in relation to obtaining the obtaining the balance confirmations would remain same. Next, as regards the bill discounting, verify that the proper records or documents have been maintained for every bill discounted. Test check some transaction with reference to the documents maintained, ascertain whether discounting charges, etc. have been duly accounted for. Yeah. Check whether the NBFC has not lent, invested in excess of specified limits to any single borrower or group of borrowers as per the prudential norms. So once again, it's in continuation of the point that we have discussed. Next, auditor should verify whether NBFC has adequate system of proper appraisal and follow-up of loans advances. In addition, he may analyze the trend of its recovery performance to ascertain that the NBFC does not have an unduly high level of NPAs. So this is all about assessment of NPA. And in terms of assessment of NPA, what's the process of the NBFC? Basis which they would determine whether an advance should be an NPA or not. Okay. Check the classification of loans and advances, including bills purchased, discounted, made by NBFC into standard assets, doubtful, or all of these categories, and adequacy of the provisioning around it. So once the asset has been identified in terms of its segregation, means whether it should become standard, substandard, then of course whether the provisions which are required by the prudential norms, whether those provisions have been created or not. So this is again going to be a mathematical computations. But as regards most of these procedures and most of these requirements, the auditor would have to appreciate the fact that these days, to gather all of this data, to analyze all of these data is not very easy if the auditor is looking at only the manual testing. So these days, because of the strong IT environment on which the companies are working, including the NBFCs, and particularly the financial institutions, wherein the number of transactions is really voluminous. So therein, the involvement of IT teams and the usage of the IT teams or the IT tools for testing of various requirements is very, very important on the part of the auditor. Yeah, various reports are required to be generated from the systems, which become the basis for the audit of the NBFCs. So this is one area which has become increasingly important these days. Okay. Now, even though we have discussed various procedures as around this type of NBFC, still there could be various other procedures which may be coming to your mind also. You may be thinking, sir, can we have this procedure? Can we have this procedure? Can we have this procedure, which is not really listed down? And will it be okay? Yes, of course, this will be okay. Now, as around all of these procedures, please understand that this list is only illustrative. So if there is any other procedure which you believe is relevant, and relevant when you say relevant, this should be in line with the prudential norms, or this should be in line with the general audit procedures. So that should also be covered over here. I'll give you one example. So in any of these procedures, there's no specification around the control testing. So you can very easily design a procedure around control testing. Now, control testing could be for various areas other than the substantive testing. There is no specific procedure around the analysis which are required to be done. And in case of NBFC, analytical procedures are significantly required to be performed. Because to audit such data is not possible if you are not designing proper analytical procedures. So those are again very, very important. There are so many ratios which the prudential norms require NBFCs to maintain. So all of those ratios, all of those analyses are required to be done by the management of the NBFC, and which are then required to be verified by the auditor also. Okay, clear on this? Now we'll move on to the next step, that is about auditor's report, auditor's duty, as around various things. So let's move further. So let's understand the duties of the auditor. So what are the duties of the auditor? First, of course, is to issue the audit report. Yeah. RBI directions have considerably increased the responsibility of the auditors. A very onerous task of reporting to the board of directors. Now there's a duty to report to the board of directors on certain specified matters, and also to the RBI on an exceptional basis has also been imposed upon it. And this reporting requirement is in addition to the normal reporting which will go to the shareholders. Normal reporting means, if you remember the audit report that we discussed, that audit report goes out to the members of the company. Members means the shareholders of the company. So in case of NBFC, this being a company, its statutory audit will be performed. And because its statutory audit will be performed, so that's why the audit report of the auditor of NBFC will go to the members of the company, shareholders of the company. And all of those reports will be similar to what we discussed in case of any other company. Over and above that, there are certain specified matters on which a specific reporting will be done by the auditor to board of directors. So this is number 2. So there are 2 requirements. One is audit report to the members. Second is reporting to board of directors. So this is over and above the audit report. Number 3, in certain exceptional cases, at times, auditor may also be required to report to RBI. Okay. Yeah. Clear on this? Okay. Now we'll get on to the details around reporting to the board of directors and reporting to the RBI on exceptional basis. The report as around the audit which has to be given by the auditor. Yes, reporting to the board of directors. RBI has issued certain directions to the auditor of every NBFC, and these directions once again will vary depending on the type of NBFC it is. For example, systemically important non-deposit taking NBFC, there are directions. Non-systemically important non-deposit taking NBFC, there are directions. Then deposit taking NBFC, there are directions. Similarly, for the purposes of audit, for the purposes of requirements of audit, there are again different set of directions which are required to be complied with. Okay. The direction shall apply to every auditor. Now, these directions shall apply to every auditor of the NBFC. So let's understand the requirement. Auditors should submit additional report to the board of directors. And what is this? In addition to the report made by the auditor under section 143, so that means the normal audit report on the accounts of NBFC, etc., the auditor shall also make a separate report to the board of directors of the company on the matters specified herein. So what are the matters? Matters to be included in the auditor's report to the board of directors. So the auditor's report on the accounts of NBFC shall include a statement on the following matters, namely, in case of all NBFCs. Now these points will apply to all the NBFCs. So what are these points? 1. Conducting NBFC activity without a valid certificate of registration granted by RBI is an offense. Therefore, if the company is engaged in the business of NBFC and meeting the principal business criteria, auditor shall examine whether the company has obtained certificate of registration from the RBI or not. So that means the first procedure that the auditor will have to perform will be to check and to report whether the company is NBFC or not. And it's not necessary that the company may be registered as an NBFC with RBI. At times this may be missed. So it may be possible that the company is an NBFC, and being an NBFC, it is carrying on the business. You remember the financial activity 50-50 test. So this company is passing that test, and therefore the company should have got registered as NBFC, but the company did not do that. So this is a specific reporting which is required to be done, because in such a case, it's a non-compliance. Next, in case of a company which is holding the certificate of registration, whether the company is entitled to continue to hold such certificate of registration in terms of its principal business criteria as on the March 31 of the applicable year. So if there are any changes which would have been required, whether the certificate of registration is still valid or not. So that is again one area which will have to be checked by the auditor. Third, whether the NBFC is meeting the required net on requirement as laid down in the regulations. Net on funds, if you remember, we discussed that every NBFC is mandatorily required to fulfill two conditions. One, obtaining certificate of registration. Second, that is about having minimum net on funds, minimum capital. Now, in this part, when the auditor is required to report on certain matters in case of all the companies, all the types of NBFCs, then the auditor is actually looking at these two mandatory conditions. One, that is about certificate of registration, and second is about minimum net on funds. Because if there is any violation, then this will impact the very existence of NBFC. The business which the NBFC is doing in such a case will be considered to be not in compliance with the law. So that will be considered to be illegal, and which may have a serious implications. The company may have to shut its operations immediately, and its license around operations in respect of any activity it may be doing may be cancelled, and a heavy penalty may be imposed on that. Okay. So every NBFC shall submit a certificate from its statutory auditor that it is engaged in the business of NBFC, requiring it to hold certificate of registration, and it is also eligible to hold this. Okay. Moving on to next. Now these procedures or these requirements on the part of the auditor we discussed for every type of NBFC. Now let's move on to the second requirement, which will apply only to the NBFCs which are accepting or holding public deposits. Only to those NBFCs which are accepting or holding public deposits. Means this will not apply to all. Secondly, you should also understand the fact that these requirements as per point number B will be over and above A. So let's understand this. What do we mean by over and above? So we are talking about auditors reporting. So first of all, we understood that it is in respect of all NBFCs. So the auditors reporting in respect of all NBFCs were first about certificate of registration, and second point was about, so the first point was about certificate of registration, and the second point was about, I would say this was A. Second point was about net on funds. Okay. Now this is something which will remain for all the NBFCs, and therefore when we move on to the second requirement, requirement number B, which will apply to those NBFCs which are accepting or holding public deposits. NBFCs accepting or holding public deposits. So now all of these requirements that we'll discuss over here will be over and above this. So that means all these points A1 and A2 will apply to these NBFCs also. And over and above that, more points will come. Okay, so let's understand these points now. First, in relation to NBFC, what's the first point? Whether the public deposits accepted by the company together with other borrowings indicated below from public by issue of unsecured non-convertible debentures. So we are talking about public deposits accepted together with these types of borrowings. Okay, from its shareholders, which are not excluded from definition of public deposit. Yeah, which are not excluded from the definition of public deposit in the NBFC acceptance of deposit directions are, so what's the requirement? Are within the limits admissible to the company as per the prudential norms. So are those within the limits? If those are within the limits, it's okay. And this is a reporting which is required to be done. Second, whether the public deposits are in excess of the quantum of such deposits permissible to it. Third, whether the NBFC is accepting public deposits without minimum investment grade credit rating from an approved credit rating agency. Fourth, whether the capital adequacy ratio as disclosed in the return submitted to the bank in terms of the regulatory requirements has been correctly determined, and whether such ratio is in compliance with the minimum CRAR prescribed therein. Fifth, in respect of NBFCs which are referred to in point number 3 above. 3 was about obtaining minimum investment grade credit rating, whether the credit rating, whether the credit rating for each type of fixed deposit schemes has been assigned by one of the credit rating agencies, which is approved, and whether the aggregate amount of deposits outstanding at any point of time during the year has exceeded the limit, whether the company has violated any restriction on acceptance of public deposits as provided in NBFC directions. Then moving further, whether the company has defaulted in repayment to its depositors, the interest penalty, the interest principal, anything around this, whether the company has complied with prudential norms on income recognition, whether the company has complied with the requirements related to liquid assets to be maintained, whether the company has furnished to the RBI within the stipulated period the return on deposits. Next, whether the company has furnished to the RBI within the stipulated time quarterly return, whether in case of opening of new branches or offices to collect deposits, or in the case of closure of existing branches or offices, or in the case of appointment of agent, the company has complied with the requirements contained in directions in relation to those NBFCs. So if you will understand, okay, if you would have gone through all of these points, what do we understand? That all of these points are in respect of compliances related to the public deposits. So I would say this point number 1 is about compliances in relation to acceptance of deposits, and number 2 we can say compliance in relation to holding of deposits. If we have to put all of these points in a very generic term, means if I have to just generalize all of these points, let's understand the way we can do this. And this will be again important for all of you, because that's how you can just avoid mugging up all of these points. We understand that these are the specific reporting requirements in relation to those NBFCs which are accepting public deposits. So when the public deposits will be accepted, so certain norms, certain directions will have to be fulfilled. One, that if the deposits have been received, if the deposits have been accepted, then are we accepting the deposits within the prescribed limits? If those have exceeded, have we ensured that the reporting has been done that these have exceeded the limits, or the excess which was received has also been sort of repaid so that the limits are maintained up to the required levels? Secondly, there are certain approving agencies which are again prescribed by the prudential norms. Whether all of those agencies have approved obtaining of these funds. If the funds have been obtained, because deposits are what? These are funds. These are coming from the public. So that's why it's very important to ensure that the repayments as and when due are being made on time. Any interests are being paid on time. There should not have been any defaults. As around these deposits which have been accepted, and because these deposits belong to the public, so that's why NBFCs should also have some liquid funds, so that whenever they become due, NBFC is in a position to repay that. So whether that liquidity or those liquid assets which were required in respect of these public deposits were maintained by the NBFCs throughout the period or not. Yeah. So most of these compliances are what? These are very general to understand, and it's good to add the technical language wherever it is required, but at the same time, first important step for us is to understand it conceptually. Yeah. So in the exam, this is how you should try to remember all of these points, and then of course top it up with various regulatory requirements which are applicable. Clear? Now, moving on to the third category. Third category is about those NBFCs which are not accepting public deposits. So let's understand what are the requirements in relation to them. So I'll just write third category C, which is NBFCs not accepting public deposits. So let's understand the requirement in relation to those NBFCs. So now these requirements under C will also be over and above A. So that means every NBFC will require to fulfill A plus specifically for these NBFCs requirements related to C. So that means for B, A should be added. For C, A should be added. So A will be added to both B and C. So it says, apart from the aspects enumerated in A above, auditor shall include a statement on following matters. So what's the matter? Whether the board has passed the resolution for non-acceptance of any public deposits. Yeah. So if the NBFC is not accepting public deposits, then the board should have passed the resolution, whether that has been done or not. Whether the company has accepted any public deposits during the rally. So even though the NBFC should not have accepted the public deposits, but still it will be required to be checked whether the company has actually accepted when it was not required to do that. Next, whether the company has complied with prudential norms related to income recognition, assets classification, etc. In respect of systemically important non-deposit taking NBFCs, whether the capital adequacy ratio as disclosed has been correctly arrived at in the return, whether the company has furnished to the RBI annual statement of capital funds, means various reporting requirements which are there in respect of capital adequacy ratio, in respect of capital which is required to be maintained by the RBI, whether that reporting has been done as per the directions or not. Whether the NBFC has been correctly classified as NBFC microfinance institution as per the definitions given in the directions. Okay. So now in this case, what is it that we are looking at? We are looking at those compliances which are again in the nature of public deposits, particularly. Now we are first of all checking that there are no public deposits as an auditor. Because if there are no public deposits, then it's good to know. Because why? Because of the fact that these NBFCs should not have accepted any public deposits. So if they have not accepted, then it is okay. Secondly, to check why it should not have accepted, because this is not as per the policies, procedures of the NBFC. And third will be about its assets classification, income recognition norms. And fourth will be about the capital adequacy, capital norms. And all of these norms will be looked at from the directions, which will be applicable at that point of time. Okay. Fourth category. Fourth category. So I'll not put it on the board. It's very small point. In respect of a company which is engaged in the business of NBFC, which is not required to hold certificate of registration subject to certain conditions. So now over and above point number A, let's see what is it that will be required to be done by such company. The auditor shall include a statement that the company is complying with the conditions stipulated as advised by the RBI. So in case there is a company which, let's suppose, is not required to obtain certificate of registration because it has obtained the approval of not obtaining the registration, in which case RBI must have advised certain conditions would be required to be fulfilled by such company. Now for such company, such conditions which are required to be fulfilled, whether those conditions have been fulfilled or not. Yeah. So this is one area which will have to be verified by the auditor. Clear? Next, reasons to be reported for unfavorable or qualified statements, where in the auditor's report, the statement regarding any of the items referred to in paragraph 3 above, wherein we discussed all of these compliances related to accepting public deposits, not accepting public deposits, or not obtaining the certificate of registration, is unfavorable or qualified. So let's suppose if there is any unfavorable comment has been given by the auditor, qualification has been given by the auditor in respect of any of these points, B, C, D, as the case may be, then the auditor shall also be required to give the reasons for such statement, give the reasons of unfavorable comment, give the reasons for qualification. If the auditor is unable to express any opinion, his report shall indicate such fact also together with the reasons. So it's all about giving the reasons as to why such qualification or why such adverse comment has been included there. Okay. Yeah. So these were the points which are in relation to the reporting to the board of directors. Now, over and above this, we understand that there are certain obligations which have been imposed on the auditor in relation to reporting to RBI. And we call it as an exception report. Exception report means that this report will not be required to be given every time. Only when such exception will arise, then this report will be required to be given. So let's understand the requirements of this report. Yeah. Let me just go to your questions. Ambika is saying, sir, if if NBFC is complying with all its requirements, then also it is to be specifically reported. Yes. So it's a specific reporting. So it's not that only when there is an exception this will be required. It's a specific report which has to go out in respect of these matters, but only in respect of these matters we have discussed. Okay. All right. So coming back to the reporting requirements to RBI, where in case of an NBFC, the statement regarding any of the items referred to in paragraph 3 above. Paragraph 3 was all about these points we have discussed. Yeah, this one, this one, this one, and this point number D. Okay, and that is unfavorable or qualified. So if any of these reportings is unfavorable or qualified, or in the opinion of the auditor has not been complied with, the provisions of RBI Act or the norms related to public deposits or any of the directions which are applicable to such NBFC, let's suppose if those have not been complied with. Okay, so it's all about certain prudential norms, certain directions, or in simple terms, we can say certain regulatory requirements which were applicable to the NBFCs, but those have not been complied with. Then it shall be the obligation of the auditor to make a report containing details of such unfavorable or qualified statements and or about non-compliance. So one is, so let's understand what's the auditor's reporting to RBI. So one is in respect of any of these, there is a qualified or unfavorable, or you can say adverse comment. Okay, then we are saying this is one. So this is first. First is this. What's the second point? Second point is non-compliance of regulatory requirements. Non-compliance of law. And in terms of law, what are those regulatory requirements we just discussed? So in case it's either of this, first or second or both, first or second or both, in such a case, what will the auditor do? Auditor will report to RBI. Clear? Simple, easy to understand. In such a case, auditor will report to RBI. It shall be the obligation of the auditor to make a report containing details of such unfavorable, qualified statements or such non-compliance in respect of the company to the concerned regional office of the Department of Non-Banking Supervision of the RBI, means to the RBI, under whose jurisdiction the registered office of the company is located. The duty of the auditor shall be to report only the contraventions of the provisions of RBI Act or any of the directions or any of the prudential norms, and such report shall not contain any statement with respect to compliance of any of those provisions. Now, what does it mean? It means that when the auditor will report, then the auditor is not required to provide any checklist to RBI. Let's suppose there's an NBFC which has got 9 conditions to be fulfilled. Or you can say there were 9 provisions which were applicable to this. Okay, yeah. So this has been complied with, this has been complied with, this has also been complied with, this is non-compliance, this is non-compliance, this is complied with, this is complied with, and this is a non-compliance. Okay. Now, the duty of auditor is not to report all of these compliances. So it's not a compliance checklist which has to go to RBI. RBI is not there to look into each and every requirement of this NBFC, whether it has fulfilled that or not, whether this has ensured compliance with that or not. What's the idea? Idea is that the auditor is there to check all of these points, and only the non-compliances, means these two and this one, are getting reported to RBI. Only these two. Sorry, 3 points over there. Huh? Clear? And that's why this has been called as exception reporting, which means that if during a particular year all of these requirements have been taken care of by the NBFC, so will there be any reporting on the part of the auditor to the RBI? No. So only and only when there is a non-compliance in respect of any of these requirements which are specified therein, then the reporting will go, otherwise it will not go. Clear on this? Clear on this requirement related to reporting to RBI? Okay, so now moving further on to the requirements related to CARO. So now in a way we are going back to some of the requirements related to audit that we discussed for other companies also. CARO, if you remember, we discussed when we were discussing about the audit report, that CARO goes along with the main audit report. And now in case of NBFCs, we can say there are 3 reportings which are required. One is the audit report. So now for NBFCs, we understand there are 3 types of reporting. One is the audit report to the members, which will also include CARO, etc. So I'm not writing all of those points. Number 2, to directors, reporting to directors of the NBFC. Number 3, reporting to RBI. So this was to members, this was to directors, this is to RBI. But to RBI is only when required. When required. These 2 will go always. This one will go only when it is required. This will not be going every time. Correct? This will not be going every time. Now, in relation to this audit report, which will go to the members, there's one report which goes along with this, that is called as CARO. So I am now going to discuss about that CARO. Now CARO, though has been introduced with some revisions, some changes in the form of CARO 2020, but for the purposes of your examination, you need to refer CARO 2016 only. Okay, yeah, so that's why we will discuss CARO 2016 and not CARO 2020. Though I'm sure you will be all knowing about it, but still, some of you, if you don't know, you can just note down that for all of you, it is CARO 2016 which is applicable right now. So now we will go to the provisions of CARO 2016 and will understand What is the relevance of those provisions? What is it that the auditor of NBFC would be required to do in that context? First, whether the company is required to be registered under Section 45 IA of the RBI Act, and if so, whether the registration has been obtained or not. So this is all about the registration requirement of the NBFC. First, the auditor will need to check whether the company is required to get registered as NBFC or not. If yes, whether that registration has been done or not. And you may be thinking that this reporting we have already discussed in relation to point number A, which has to go out to the board of directors specifically. So is it not a duplication? No. So this report is Caro report, which goes along with the main report to the members. And same point could be there in respect of the reporting requirement of the auditor to the directors. Okay. So the procedures in relation to both these points, therefore, may become similar, but that is okay. It's about sending the report at two places. The auditor is required to examine whether the company is engaged in the business which attract the requirements of registration. Means whether the company is NBFC or not. And if that is exempt from the registration requirement of RBI. And if you remember, we discussed about certain NBFCs. Because those NBFCs are governed by some other act, some other legal requirements. That's why the registration for those NBFCs is not required under RBI Act. So if that is the case, auditor will have to check it. Auditor will have to verify it. And this is again on the basis of the discussions with the management. This will be on the basis of the understanding of the business of the NBFC. RBI restricts companies from carrying on the business of NBFC without obtaining certificate of registration. An NBFC is a company which is registered under the Act, means the RBI Act, engaged in the business of loans, advances, acquisition of shares, stock, etc., issued by government or local authority or other marketable securities, and so and so. So this is all about the definition of NBFC. Yeah. Then it further says that the NBFC will also become an NBFC if it is meeting the criteria of 50-50, means financial assets of NBFC or that company are greater than are in excess of 50% of the total assets, or the financial income which is generated from the activities related to such NBFC business, they cross 50% threshold out of the total out of the gross income of the NBFC. So these are some of the conditions which the auditor will have to analyze. Auditor will have to check, on the basis of which such NBFC or such company may become an NBFC, and because of which that company may be required to obtain certificate of registration, which it might have not obtained. So this is another area which the NBFC will have to check, and which the auditor will also be required to check. And if there is any non-compliance in relation of this, then that is required to be not only report to RBI, not only covered in reporting to the directors, that will also get reported over here under CARO 2016. Okay. NBFCs are doing functions similar to banks. However, there exists difference between banks and NBFCs. When the auditor will be looking into all of these activities of the NBFC, on the basis of which auditor will analyze whether that company should become an NBFC or not, auditor will also be looking at those differences between the bank and NBFC. So, because only those activities which will lead to that classification of an NBFC should be considered by the auditor. Yeah. Next is about maintaining the net on fund. So NBFCs are also required to maintain minimum net on fund. So whether the NBFC is maintaining those minimum net on fund or not. Okay. Now let's understand, even though we have discussed about it, but let's understand what could be the audit procedures in relation to this. The auditor should examine transactions of the NBFC or of that entity. Financial statement should be examined to ascertain whether the financial assets constitute more than 50% or not. Yeah, whether the financial income constitute more than 50% of the gross income or not. Then the financial statements would also be verified. The net on funds which are there in the financial statements will be checked whether that is as per the minimum threshold prescribed for the NBFCs or not. The certificate of registration which would have been obtained by the NBFC, that will also be required to be verified by the auditor. The auditor should report incorporating the following: whether the registration is required under section 45 IA of the RBI Act, and if so, whether it has obtained the registration. If not, what are the reasons? What are the reasons of not obtaining such registration? So both of these requirements are required to be fulfilled by the NBFC, and therefore any exceptions around it are required to be captured by the auditor. Clear? And very simply, this will be done by the auditor on the basis of understanding of the business and on the basis of just analysis of the preliminary level of financial statements. Because when the auditor will be starting the audit, so the financial statements may not have been finalized. So it may be a draft financial statements available to the auditor. So that's why on the basis of the draft numbers only, he will be able to make out whether this criteria is fulfilled or not. And these situations will be rare, wherein the company is getting onto the business of NBFC, but still it has not obtained the certificate of registration. Okay, these situations will be rare, but at times it happens that some of the companies get into the business of NBFC unknowingly. So they may be advancing the loans, they may be generating the income from those loans, but they may not be very sure as to whether they have really crossed this threshold which was required for the NBFCs, and that may become a problem for them later on. Yeah, so all of those factors are therefore required to be analyzed by the auditor. Clear? Yeah. So this is the first requirement in relation to NBFCs as far as Caro report is concerned. Moving on to the second requirement. Now, second requirement which comes for Caro, which comes under Caro. So let's see what is this second requirement in Caro in relation to NBFCs. Whether the Nidhi company. Now, this is specifically for Nidhi companies. Those NBFCs which are Nidhi companies. So that means this doesn't apply to each and every NBFCs, only the NBFCs which are Nidhi companies. Whether the Nidhi company has complied with net on funds to deposits in the ratio of 1:20 to meet out the liability. So that means it appears as if, so while I read this para, it appears that Nidhi companies should have a ratio of 1:20 in respect of net on funds to deposits. Means if the deposits are 20 crores, then the net on fund should be minimum 1 crore. If the deposits are 200 crore, then the net on fund should be 10 crore. So that's the ratio which is required to be maintained. So whether that has been maintained or not, this is in relation to maintaining the liquidity. This is in relation to maintaining the reserves to meet out the liabilities later on. and whether the Nidhi company is maintaining 10% unencumbered term deposits, which are specified under the Nidhi Rules 2014 to meet out the liabilities. Let's understand all of these requirements. Now, the Act defines Nidhi company as a company which has been incorporated with the objective of cultivating the habit of thrift and savings amongst its members, receiving deposits from, lending to its members only for their mutual benefit, and which complies with such rules as are prescribed by central government for regulation of such class of companies. Next, let's look around the audit procedures in relation to this compliance related to Nidhi company. It may be noted that the rule or the relevant rule prescribes the requirements for minimum number of members, net on fund. As per this rule, every Nidhi company shall, within a period of 1 year from the commencement of these rules, ensure that it has not less than 200 members. So that's a minimum requirement. Net on funds of 10 lakh rupees or more. Unencumbered term deposits of not less than 10% of the outstanding deposits, and ratio of net on funds to deposits of not more than 1:20. The auditor should note that such a Nidhi company can accept deposits not exceeding 20 times of its net on funds as per the last audited balance sheet. So now this is an important criteria. As per Rule 3D, net on funds are what? They are defined as aggregate of paid-up equity share capital, free reserves, and from which debit balances of P&L and intangible assets. So that means it's about the capital of the Nidhi company. A Nidhi company can accept fixed deposits, recurring deposits, saving deposits from its members in accordance with the regulations or the directions which are prescribed, and those deposits on a cumulative basis will be considered to be the liability towards those deposits. Auditor should ask the management to provide a computation of deposit liability. Now, what is the audit procedure? Let's try to understand. It's very simple. First, auditor would obtain the list of all the deposits and would then check which all deposits would qualify for this ratio. Number two, auditor would check what's the net on fund of the Nidhi company. On the basis of these two, auditor would then verify whether the ratio is maintained at 1:20 level or not, or whether it is exceeding the prescribed ratio. If that is exceeding the prescribed ratio, then it will become adverse for the Nidhi company because that will be non-compliance. And generally, you will not see non-compliances. The auditor may report incorporating the following as at the balance sheet date. In case of shortfall in the ratio of net on fund to deposits, report the amount of shortfall, state the actual ratio. So let's suppose if the ratio which is required to be maintained is 1:20. Let's suppose the ratio which is required to be maintained is 1:20, but the Nidhi company's ratio was 1:22. So first of all, what would the auditor do? Auditor would check what's the shortfall in the net on funds. Secondly, auditor would also report the actual ratio for that company. Means the actual ratio was this as at the end of the balance sheet. In case of shortfall with regard to minimum amount of 10% as unencumbered term deposits, report the amount thereof. Now the unencumbered term deposits, which are required to be kept at 10% minimum. If those are not kept at 10% minimum, let's suppose if there is a shortfall, then such shortfall will also be required to be reported. And in relation to that shortfall, the exact number means whether that is at 8%, whether that is at 5%, whether that is 9.6%, all of those are required to be captured and reported by the auditor. Clear? Yeah. Now, in relation to these points related to CARO, you may also refer to the guidance note for further details. Though we have already discussed about these requirements related to CARO in detail, but still, if there is any specific aspect related to the CARO that you want to get into more detail, you can always refer to the guidance note, which describes each and every requirement of the CARO in detail. And this is not only limited to these two requirements. CARO otherwise is also applicable in respect of various other points that it captures, but those are not really relevant from the perspective of NBFC. Those are otherwise relevant. So that's why you should just make sure that you go through those requirements also. Okay, clear? So now before we move further, let me just come back to your queries. So Nagasai has a query around GST audit. Nagasai is asking whether the CA firm which accepted to prepare GST returns can accept appointment as GST auditor. I think I clarified this point earlier also. It's not possible because the independence will not be maintained. Okay. Harshad is asking, sir, CARO 2020 is applicable or 16? 16 is applicable to you for this relevant examination. Then I think I answered the query of Ambika. Okay, so now next point would be around Ind AS. But I think before we move on to the requirements related to Ind AS on NBFCs, we can take a break. So let's take a break of 10 minutes. After the break, we will complete our discussion in relation to NBFCs because this happens to be the last concept around NBFC. And then we'll also look at some examples. So we'll also look at some MCQs based on this concept or various concepts related to NBFCs. And after that, we'll also start the new chapter on audit of insurance companies. Okay. So let's take a break now and we'll meet after the break. Hi, welcome back. So we'll continue our discussion now, and we will move to the requirements related to accounting standards. Okay, so this is all about Ind AS now. We understand how the Ind AS are becoming applicable to all the companies. So it was a phased criteria wherein some of the Ind AS became applicable up to a particular date. Then after a particular date, some more companies got covered within the purview of Ind AS, and all of these companies that we have been discussing were all other than the banks, other than the NBFCs, other than the insurance companies. Now, after these companies got covered under the purview of Ind AS, then came the NBFCs. So now, as regards these NBFCs also, Ind AS is something which has already become applicable. But let's understand what is the applicability for, or what's the criteria of applicability of Ind AS, and what's the basis of ascertaining whether whether an NBFC will get covered under Ind AS or not. Applicability of Ind AS is determined on the basis of net worth, first of all. So therefore, NBFCs which have a net worth of 500 crore rupees or more, whether those are listed or unlisted, it doesn't matter, which had a net worth of 500 crore rupees or more, on those NBFCs, accounting standard became Ind AS. Means the relevant accounting standard for those NBFCs became Ind AS. Means Ind AS became applicable on those NBFCs. And it's 18-19. That means the financial year for those NBFCs, the reporting year, the first reporting year for those NBFCs was 18-19. But it's all done now. 18-19 is all gone now. So that's why I will not get into too much details around it, because we understand it's already applicable. Secondly, any of these NBFCs which got covered under Ind AS in this phase 1, so I'm calling this to be phase 1. 1st April 18 onwards is the phase 1. Now, any of the subsidiary, any of the holding, any of the joint ventures, or any of the associate companies of such NBFCs which got covered under phase 1 also got covered under phase 1. So let's take an example. Let's take an example to discuss this. See, an NBFC had a net worth of 600 crore. Now this got covered under phase 1. Phase 1 means financial year 18-19. If this NBFC had any associate, this NBFC had any subsidiary, holding company of this NBFC, if any, or joint venture of this NBFC, even though these companies did not meet this criteria of having a net worth of 500 crore or more, still those companies, they also moved into phase 1. So that means on those companies also Ind AS became applicable from financial year 18-19. Okay. Now this criteria of net worth of 600 crore was irrespective of the fact that the NBFC is listed or unlisted. It doesn't matter whether that's listed or unlisted. Okay. Next criteria was applicable to those NBFCs which did not get covered in phase 1. That means in phase 2 some more NBFCs were covered on which Ind AS became applicable, and these NBFCs were the ones which had a net worth of less than 500 crore. Why? Because if the net worth was more than 500 crore, that NBFC would have become, Ind AS would have become applicable on that NBFC from 1890. Now we are talking about NBFCs which had a net worth of less than 500 crore, but which had a net worth of 250 crore or more. And similarly, any holding of this, any JV of this, any associate of this, any subsidiary of this, irrespective of the net worth, that also got covered under this phase 2. Means Ind AS applicable, Ind AS became applicable to that NBFC. Plus, any listed NBFC irrespective of net worth, if that is not already covered in phase 1, those NBFCs also got captured over here. So that means in phase 2, listing criteria also mattered. In phase 2, therefore, 2 criteria became the basis for applicability of Ind AS. One, net worth, and second is listed or unlisted. And both these criteria are not required to be looked at on a joint basis. Those are independent. Means there could be an NBFC which has a net worth of say 260 crore, but which is unlisted. So Ind AS will become applicable to that. There could be an NBFC which is listed, but whose net worth is say 180 crore. On that NBFC, Ind AS becomes applicable. And any NBFC which gets covered under phase 2, either because of net worth criteria or because of listing criteria, any holding, any JV, any subsidiary, any associate of such NBFC also gets covered under phase 2. Clear? Okay, clear all of you? Now we can also flip through the format of the financial statements of NBFC. Now, similar to any other company, Schedule 3 prescribes a format of financial statements for NBFCs also. So Schedule 3 has got 3 divisions. First division talks about or specifies the format of financial statements for those companies on which Indian GAAP is applicable. Division 2 lays out the format of financial statements for those companies on which Ind AS is applicable. And Division 3 of Schedule 3 lays out the format of financial statements for those NBFCs on which Ind AS is applicable. Okay, Division 3 of Schedule 3. This lays out the format of financial statements on which Ind AS is applicable. So we can just quickly flip through this format. We can just look around some of the requirements. So first of all, we have got financial assets. Yeah, so it starts with the financial assets. There are various categories of financial assets. Then it moves on to non-financial assets. Inventories, deferred tax, PPE, goodwill, intangible assets, they are all what? Non-financial assets. Correct? So then it moves on to liabilities and equity, and on the liabilities it starts with financial liabilities. It starts with the financial liabilities. First of all, it captures the financial liabilities. In terms of financial liabilities, there could be various: trade payable, borrowings, deposits, or any other financial liability which the NBFC may have. Then it moves on to non-financial liabilities. Then it moves on to non-financial liabilities, which could be about deferred tax liability, provisions, etc. And then it moves on to equity. So this third part is not really non-financial liability. This is typing problem. Yeah, so this is equity. So the third part is about equity. So that is the non-financial capital. That is called as non-financial capital. Okay. Next, it talks about the format of the P&L. Now, in terms of the format of the statement of P&L, all the line items of the statement of P&L will be there. The revenue, expenses, then we have this profit, and then it also picks up other comprehensive income. Other comprehensive income, which is applicable under Ind AS. So that gets covered, and the total of this other comprehensive income and the profits from this first part of the P&L, that gives us the total of the statement of P&L. Okay, yeah. There are certain differences between Division 2 Ind AS, which is the format of the financial statements, and which is the relevant format for Ind AS financial statements, and which applies to companies other than NBFC. Vis-a-vis this Ind AS format of financial statements in relation to NBFCs. So let's quickly flip through some of those differences in relation to the format. First, if you would have observed, NBFCs have been allowed to present the items of balance sheet in the order of their liquidity, which is not allowed to the companies other than NBFCs. So I'll just take you back to the format of the balance sheet. So if you'll see the format of the balance sheet, you can see in the order of their liquidity, the assets have been given. Correct? Can you see this? Assets have been captured in the order of their liquidity. Okay. Which is not the case for companies other than NBFCs. Additionally, NBFCs are required to classify items of balance sheet into financial and non-financial, whereas other companies are required to classify the items into current and non-current. An NBFC is required to separately disclose. An NBFC is required to separately disclose by way of a note any item of other income or other expenditure which exceeds 1% of the total income. Whereas in case of other than NBFCs, this criteria is 1% of the revenue or 10 lakhs, whichever is higher. Yeah. So here it is 1% of total income. There it is 1% of revenue or 10 lakhs, whichever is higher. So 10 lakhs is the limit which has been sort of specified at the lower level. Next, NBFCs are required to separately disclose under receivables any debts which are due from LLP in which director is a partner or a member. Okay. NBFCs are also required to disclose items comprising revenue from operations and other comprehensive income on the face of the statement of P&L instead of showing only as part of the notes. In case of companies other than NBFCs, all of these disclosures appear in the notes and not on the face of the statement of P&L, which is not in the case of NBFCs. Okay, they are required to disclose all of these on the face of the P&L statement only, because of which the face of the P&L statement would be bigger as compared to what you see in Ind AS financial statements of companies other than NBFC. Okay, clear? So with this, we come to an end to our discussion on NBFCs, the audit procedures around it. Any questions in case you have on this, you will let me know. And now we'll also pick up some examples to discuss the requirements of audit of NBFCs. Okay, yeah. So any questions, any doubts in case you have, you may ask me. Now we'll pick up some examples in relation to audit of NBFCs. Okay, so let's suppose this is an NBFC whose audit is going on for 2020-21. Its net worth was say 315 crore. Okay, its net worth was 315 crore. Now, during the course of the audit, auditors have faced certain problems in relation to the audit of advances. So let's understand what's the problem auditors have faced. Auditor found that the NBFC did not have any specified policy in relation to giving the advances. Specified policy documented, okay, or we can say specified documented policy was missing in relation to the advances which are given out. Yeah. And because of which auditors faced big problem in terms of testing of advances. Means whether the advance should have been given to a particular customer or not, or whether advance should have been given up to a particular threshold to a customer or not. Yeah, so huge problems were faced. When all of these things were discussed with the management, they came out with certain regulatory documents. Let's suppose there were certain regulations which are prescribed, with which they came out And they said that even though they don't have any documented policy, but still all of these regulations are in place and the NBFC has been strictly complying with all of those regulations. So I would say, but complying with the regulations strictly. Okay. Still, the auditors were not comfortable, and that's why they increased the extent of their testing. But auditor could not find any significant observations in relation to the advances given. As regards the classification of NPA, as regards the classification of NPAs into different categories, everything was found to be in order, because the auditors were really focused on the policies and which were not available. So that's why auditors were still not comfortable the way this business has been going on, and that's why they would like to report this matter in their report. Okay, so they would like to report this matter in their report. Secondly, they are also considering, so it's a legal evaluation they are doing, whether in respect of this matter, they should reach out to RBI. They are also evaluating whether in respect of this matter, they should reach out to RBI and report this. So the reporting implications are evaluated. 1. In their audit report, it will be captured. It's been decided. Auditors have decided to report. RBI reporting is under evaluation. So that's a question mark. They are not too sure about it. So they will evaluate and report. Okay. Next is in relation to the capital adequacy ratio. Yeah. Capital adequacy ratio, as per the understanding of the auditors, should have been 15% minimum. Next is the capital ratio. This should have been 15% minimum. Auditors found this to be 14.95. Okay, so the actual ratio was 14.95%. The difference is insignificant, isn't it? Auditors would want to report this non-compliance also. Management has asked the auditor to look into the materiality. Also look at the fact that it's very closer to the minimum threshold requirement. But the auditors are not convinced. So auditors seems to have taken a very strict stand of reporting this. Okay. Yeah. So this is the next thing which the auditor would want to capture in relation to their reporting requirement. All right. But the management is not fine with this reporting requirement or all of these positions which the auditors plan to take. So that's why your views are required to suggest what should be the course of action in the given scenario. And again, what I'll do here is I'll put the numbers around it. And one thing which I forgot to specify over here was around the gap, around the applicability of the gap. In relation to this NBFC and when it comes to the capital ratio, etc., there's also one plea of the management. Management is saying that now the Ind AS is applicable on the NBFC. Okay, Ind AS is applicable on the NBFC. And because of Ind AS, certain accounting requirements have got changed. So earlier it used to be more than 15% or always in excess of what was required. It's because the financial statements have been prepared as per Ind AS. That's why this limit seems to be lower than 15%. And the management has asked the auditor to recompute this number in line with Indian GAAP requirements. And the management is saying, if you move back to Indian GAAP, if you compute this number as per the Indian GAAP, then this number will be in excess of 15%. Yeah, so that's again the submission of the management, but the auditor is not convinced. Okay, clear? So let's understand what should be the implication over here. Now on first point, in relation to the audit reporting, I think auditor has a fair point to report this matter, not only in the auditor's report but also to RBI, because there's a strict there's a significant non-compliance. So reporting should be done to both. I'm saying to both. Point number 2, you can also start analyzing it up and start sharing your answers. Point number 2, I think auditor is taking a very harsh stand, and just a shortfall of 0.05% is nothing. If you look at the size of the NBFC, it seems to be a decently sized NBFC, and therein such shortages are okay. There's absolutely no problem. This doesn't really call for any reporting requirement. So the reporting is not the correct stand to be taken. Option number B, in relation to the advances, when everything has been fairly stated in the financial statements, it's only the documentation which is a problem. But because of the documentation, there's no financial impact anywhere. There's no non-compliance anywhere. So that's why question of reporting either in the auditor's report or to RBI doesn't arise. So reporting seems to be not the right stand to be taken. And in relation to the capital ratio, because it's the rule, okay, so it's not something which is a judgment which is required. It's not something which is considered to be an assessment. So it's a rule. Something which has to be 15% has to be 15%, irrespective of whatever is applicable. Ind AS, Indian GAAP. So there are again norms prescribed for this, basis which this ratio is required to be computed, on the basis of which, if it falls below 15%, then of course some reporting around this or not maintaining the minimum capital ratio should be there. Okay, so in terms of reporting, comments, unfavorable comment is required to be given. So it's not that the financial statements will get qualified. No. So we are saying unfavorable comment in regard to this compliance needs to be included. Number 3. Number 3 is to report on both the matters. Number 3 is in respect of both the matters, reporting should be given. And number fourth option can be not to report on both the matters. Both the matters means point number 1 as well as point number 2. So what do you think will be the right course of action in the given situation? What do you think will be the right course of action on the part of the auditor in this case? Yes, any responses from your side? We'll also analyze all of these options now one by one. Nagasai wants to go with option number B. So let's analyze all of these one by one. Now, in relation to the advances, let's understand if there is any impact. There is no doubt that the NBFC is large, and that's why if it doesn't have documented policies and procedures, then it could lead to big challenges. It also indicates some of the controls, etc., may go missing. But if they do not have any own document of theirs, but there's a detailed regulation which specifies everything to be followed by the NBFC and which they have been following, then this doesn't call for reporting. Though definitely there could be recommendations for improvement of the documentation, but it doesn't call for reporting at all. So that's why we will say option number A will not be the right option. And with this, option number C will also not be the right option. Correct? Ambika and Chavi were going with option number C. So I think you would have understood as to why I have eliminated option number C. Because both of them were requiring auditor to report on this matter, which is not right. Moving on to option number B. So one thing we have understood that reporting is not the right thing to be done. Now let's come to the capital ratio. I think Ambika and Chavi are going with me that on this capital ratio, reporting should be done. It's not about the qualification, but something needs to be captured. It cannot be just simply be ignored. Yeah, it just cannot simply be ignored. So that's why this reporting is required to be done. Yeah, this reporting is required to be done. This cannot be ignored by the auditor. Clear? All of you? Yeah? So with this, we can therefore say option number B is the right answer and option number D also goes off. Yeah? Clear? With this, we can say option number D also goes off. So let's pick up one more example. We'll pick up one more question for this. Okay, next example. Let's suppose there's a company NBFC. This is an NBFC, yeah? So we are starting with NBFC right away. And this company has got huge advances, okay? Very big sized NBFC and has got huge advances. So the volume is significant, amount is also significant. And auditor has also considered to be a significant risk area. Significant risk area for the purposes of audit of financial statements for the year ending 2020-21. Okay. Next, as around these advances which are required to be audited by the auditor, there are certain procedures he has considered. First, auditor would like to get into the controls. Auditor would like to look into the IT control environment. He would want to get into the detailed testing of IT controls of the entity, and for which auditor has planned to include its IT team. Yeah, which will get into the general controls of this NBFC, application controls of this NBFC. Yeah, any of the system generated reports will also be picked up by the IT team of the auditor. IT environment of this NBFC is also very strong. They have got a CTO, Chief Technology Officer, with whom auditor would like to have a discussion. Auditor wants to meet and discuss the audit procedures along with its IT team. So the discussion took place, everything was understood, strategy was prepared, all of these audit procedures were performed, and certain IT controls, certain application controls were found to be not operating effectively. So there was a control failure in terms of TOC. So when the testing of controls was done, controls failed or were found to be failing, because of which auditor became very uncomfortable, and that's why auditor would like to specify it somewhere in his audit report. And auditor is considering the reporting implications. Auditor is of the view that there's no point getting into further checking around those areas, only those areas where the controls were missing. And this is because of the fact that the NBFC is a large sized NBFC, and the audit of the financial statements of an NBFC is only possible by auditing the IT environment or by getting into the audit through IT tools, etc., which is not getting possible. So that's why auditor has drawn a conclusion, and auditor would like to report on that. And the reporting implications could be serious, because some of these controls are related to the advances, and advances are big ticket items. Management is not in agreement with the view of the auditor, because all of those areas where the controls were found to be missing were already there in the knowledge of the management, and they have got some workings done, they have got some calculations done in respect of those areas to ensure that nothing goes wrong in the financial statements. Okay, there's nothing which is misstated in the financial statements because of those areas over which there was a control failure. But the auditor is sticking to his point. Auditor is saying no, this has to be reported. This cannot be any other way around. Yeah. Number one. Number two, when the auditor looked around some of the audit procedures, auditor also found the classification of advances. And in terms of the classification of the advances, auditor found that there were certain substandard assets. Okay, say those were amounting to rupees 30 crore. And I'm not talking about the total substandard assets. These were substandard assets, means substandard loans, advances. A particular category of those substandard loans amounted to rupees 30 crores, on which income was recognized in the previous year. On these assets, income was recognized in the previous year. Income was recognized during financial year 2019-20. Okay, and that interest, so this was interest income, and that interest is outstanding. Interest is still outstanding. Now, because these assets were standard, so this is only the second stage when these assets have moved from standard to substandard. This income was recognized in good faith as per the regulatory norms when these assets were standard. Now these assets have got classified to substandard. So this classification changed from standard to substandard in the current year. Okay, this classification changed from standard to substandard in the current year. Now the auditor wants that this income should be reversed. Otherwise, he will have to report. So everywhere auditor has taken a stand. Either you follow what he is saying or he will report. Very simply, huh? So auditor wants reversal of income, which is very illogical. Otherwise, auditor will report. Now the management has a problem here. And let's understand the concern of the management. This is definitely a genuine concern. This income has not been recognized in the financial year 2020. This income pertains to last year. And last year on this income, tax has also been paid. Now, if this income is reversed in the current year, there will be taxation implications. Okay, with which management is worried. Secondly, this may call for a disclosure similar to what is required for prior period items. Yeah, which is again a problem for the management. Third, management is asking the auditor to look at the number. Management is saying there should be a concept of materiality which you need to follow. Yes or no? Considering the materiality, management wants to drop it. Why? Because management is saying, look at the size of my advances. Too big. Out of which this is only 30 crores. Yeah. For the management, 30 crore is nothing. But the auditor is going by the accounting principles. Strictly by the accounting principles. So this again is a matter of discussion which has been going on, but over which there is no resolution. So that's why your help is required on both these matters. Matter number 1, matter number 2. So what should be the best course of action? How should the auditor really deal with this? Okay, what should be the best course of action? How should the auditor really deal with this? Are there any other audit procedures that he needs to perform? Or is it that needs to be reported and that's how it needs to be concluded? Or is there anything which the management can do to avoid any of the audit procedures which are increasing, or the extent of the audit procedures, or to avoid this reporting? Clear? Yeah. And I think I'll need some space here. I'll need some space. So I'll just, I think I'll clear this part out. Sorry, I had to cut down all of these points, but to create options, I'll need space. Let's look at option number 1. Option number 1 is the one wherein, though there have been a control failure, the controls are not operating effectively, but still the management is able to justify. Management is able to produce the information basis which the auditor should not find any misstatement in the financial statements, but the auditor is not really happy to go with this. So therein, the view of the management is correct that the additional audit procedures should be performed by the auditor. Or we can say alternate audit procedures need to be, and only after that a conclusion should be drawn, which is not really getting done in the given situation. Yeah, so this is first. As around second, there's no doubt that the assets are substandard now, and because of which any of the income on those assets should not be recorded, even if that pertains to the previous financial year. Yeah. So reversal should take place. Option number B. Option number B again requires alternate audit procedures to be performed and then conclude. Point number 2. Alternate audit procedures and then conclude. Point number 2. No reversal should be done because it relates to the previous financial year. No reversal because it relates to previous financial year. Option number C. Option number C says that for such a large size NBFC, for an area which is a significant risk for the auditor, for an area which is such a significant item in the financial statements of the NBFC, If the controls are not operating effectively, then there's no point getting into any audit procedure. This calls for a serious reporting, and this is a very serious matter which cannot be taken lightly. That's why auditor needs to analyze how this will be reported. So reporting is a must. The only thing which the auditor can check will be the way the reporting will be done, but the reporting is a must. Number 2, as around the standard assets, recognition of income is allowed, and when these assets were standard, at that point of time income was recognized. So this was in compliance with the prudential norms. Now because these assets have become substandard, so that's why no income will be recognized on this going further, but something which has already been recognized, and that too of the previous financial year, cannot be reversed. So that's why there should not be any reversal. No reversal. So the auditor is completely illogical in terms of requiring the reversal. It appears he has not looked at the regulatory requirements, but anyways, management should not accept it. Option number D. Option number D says reporting once again needs to be done. Reporting should be done, and this is similar to what C requires, that the reporting should be done and reversal should also be done. Means what point number A required, so the same thing is required over here. Okay. So now you can just look at it and let me know what should be the right option. Ambika is saying, sir, matter number 1 need not be reported. Okay. Matter number 2 has to be reported. Okay. But I have not given you any option around matter number 2 to be reported or not. It's about whether the reversal should take place or should not take place. Nagasai is going with option number A. Nagasai is going with option number A. What about others? What is the option that you would like to go with? Quickly, what is the option that you would want to follow? Okay, Chavi wants to go with option number D. Very good. Okay, so let's look at the options now. Let's try to analyze all of these options one by one. If you look at point number 1, there's nothing specific to NBFC actually. It's about audit procedure which is required to be performed by the auditor. And in relation to any reporting that needs to be done by the auditor, or which the auditor may be contemplating, auditor needs to ensure that the financial statements are misstated, or there is no audit procedure which he would have left out. In this case, auditor is not even looking at the audit procedure. Control testing is not the only audit procedure that the auditor has got. Substantive testing is a very important procedure on the part of the auditor, which has to go along with the control testing. If after substantive testing, auditor would have concluded that there are misstatements, then the reporting implication could have been understood. But to move on to the reporting without even performing adequate audit procedures will not be correct. Yeah. So that's why point number one is absolutely right, that alternate audit procedures should be performed. And the moment we do that, option number C and option number D go off. Yeah. So that means option number C and option number D are therefore not possible. Right? Okay. So let's look at point number 2. That is about reversal of income. Now, as per the regulatory norms, the moment an asset becomes NPA, income recognition has to stop on that. And any income will be recognized on that asset only when it is realized. And even if the income would have been recognized on such asset earlier, and which has not been realized so far, losses. That's why it will not matter whether the amount is significant or insignificant. It will not matter where requirement. Auditor can look at the materiality. That's why he can ignore this part and not report. But principally, if we have to go with this, then the reversal should take place, because nowhere in our options we are saying that this should lead some of their requirements are. And considering the time that we are into towards this session of today, will not be able to wrap up our discussion. In fact, only a very small part of this chapter will be able to cover. So that's why we'll be covering the major part of this chapter in the next session. So we'll start with a brief introduction about the insurance companies, understanding about the insurance companies, the way these insurance companies really work, and what are those specific requirements in relation to the insurance companies that we need to understand. I'm just hoping the video is all okay. Jack, can you quickly check? Video is all okay? Because I'm getting the comments, video is paused. Jay, can you quickly check? The video audio is all fine? Just give me 1 minute. Hi. I think there was some technical glitch because of this disconnection took place, and I'm hoping that video audio is all fine now. Okay, yeah. So I'm hoping the video audio is all fine now. So we are still left with some time, so we should just go through some of the requirements related to the insurance. Now, what is really an insurance? So insurance is what? Insurance is basically a contract between two parties. One, that is the insurance company, and second is the person or the party who wants to take the insurance. Now, why would this insurance why would this insurance be required? Insurance would be required when there's a risk. Let's suppose you buy a car. Now there's a risk. What's the risk? That an accident may take place, this car may be stolen, and because of this accident, let's suppose there's any damage to the car which is significant and which may require a significant amount on the part of that party to get that asset back if that is stolen, or to get the car back if it is stolen, or to get the damages repaired if those damages take place. Now there's a risk, yeah, so there's a fear. To cover this risk, what would this party do? This party would reach out to the insurance company. So this party approaches the insurance company and conveys the risk which it is having. And this risk which this party is having is then covered by the insurance company. So this risk is mitigated, this risk is covered, wherein the insurance company promises that later on, in future, tomorrow, if anything goes wrong, as far as this risk is concerned, let's suppose the car is stolen, let's suppose there is any damage to the car, then any loss which will arise due to that damage, any loss due to that unforeseen event, which is a concern to the party right now, will be made good by that insurance company. So that's an assurance. Okay, that's an assurance which is given by the insurance company. So insurance company is promising to make good such loss. And this will clear all the concerns. This will remove all the concerns of the insured, or you can say the party. And for doing this, insurance company would charge certain amount from this party. Insurance company will not provide all of these things free of cost, because if there was a fear in the mind of this party, to remove this fear of the party, to make the mind of this party clear from all of these fears, etc., which have actually got passed on to the insurance company would also want something in return. And that is how insurance company would run its business. So what's the business of the company which is into insurance? That is to remove all the fears of such parties. And what is it that they want to do with this? They are actually selling the risk. Isn't it? They are actually selling the risk. Selling the risk in a way that the risk which is sold is then taken up by the insurance company, and for which insurance company will get something in return, and that becomes the income of the insurance company. So if we have to look at these two parties, so we have insurance company on one side. So we have an insurance company on one side. And let's suppose we have party A. Now the fear, the scare of this party A is taken up by whom? Insurance company. And in return for this, insurance company will charge something from party A, and that charge will be termed as premium. So the insurance company will charge premium from party A. As against this, even though the risk is transferred to insurance company is still making money. Why? Because there is not only one party which is having such type of fear in its mind. There are hundreds, there are thousands, there are lakhs, there are crores of such parties. And therefore, what the insurance company would want to do, add all of these parties to its portfolio. So basically, for the insurance company to earn, what would they need? They would need a portfolio of such parties. And these are nothing but the customers of the insurance company. So A, B, C, D, so and so, there are so many parties. Correct? Now let's understand the risk which exists now. Now, even though this risk has been taken up by the insurance company, still this risk has not gone away. The risk still remains. It may happen that car of C is stolen, say after 3 months. It may happen that during an accident, car of B is badly damaged. This risk still remains. And whenever such risk will get converted into an actual event at any point of time in future, what would happen? It would lead to some financial loss on the part of the insurance company. It will lead to financial loss on the part of the insurance company. Why? Well, let's suppose if the car of C is stolen. Let's suppose car of C is stolen, car of D is damaged. Now, because of these damages, because of these losses which C and D would have incurred, what would they do? They would reach out to the insurance company. They would again reach out to the insurance company and they would say that you promised that whenever such loss would occur, whenever such event will take place, any of the loss that I'll incur, you will make good such losses. Correct? You will make good such losses to us. And now the time has come for you to fulfill those promises. So now what will happen? Now this insurance company will be required to pay back to C, required to pay back to D. And what is it that will go out from the insurance company to these customers? Claim. This is termed as claim. So it will be a claim which C will make from insurance company. It will be a claim, or you can say this amount which will move out from insurance company to C or D is termed as a claim. And this is nothing but a financial loss. Or we can say this is nothing but an expense. Or we can say this is nothing but an expense to the insurance company. This premium was what? This is nothing but an income for the insurance company. Now, let's understand the business rationale, because all of you would be thinking, sir, what is it that the insurance company has earned? And actually, insurance company may be making losses due to this. And why? Let's understand. See, when the insurance company will take a premium, when A was quite scared, when B was scared, they had this fear in mind about their car. They reached out to insurance company. And let's suppose the value of the car was 10 lakh. So it's not that they will pay 10 lakh to insurance company to cover the risk of the car. Otherwise, what's the point of giving this money to the insurance company? They will only give a very small proportion. Insurance company said, don't worry, I will charge a very insignificant amount, 10,000 rupees. This was only rupees 10,000. They said, if you pay a premium of only rupees 10,000, I will cover this risk. Yeah. And this was actually liked by so many, and that's why so many customers came up. And they were like, that just by paying 10,000, we can get the risk cover for our cars, which have a valuation of 10 lakhs or more than 10 lakhs. Yes or no? But now let's understand, when this damage or this loss was incurred, what happened? C claimed an amount of rupees 10 lakhs from insurance company. D claimed an amount of rupees 3 lakhs from insurance company. It claimed 10 lakhs, it claimed 3 lakhs. And which is actually required to be paid by the insurance company, and insurance company has actually paid this 13 lakhs to these two customers. Now you may be thinking, sir, what's the logic? What's the earning which insurance company has made? Insurance company must have lost money in this business deal. The answer is no. Why? Because when this premium is coming, it's not only coming from the one customer. It's coming from thousands of customers, and which will move this number to a very significant high level. And when this claim is paid, this claim will not be paid to each and every customer. Why? Because these events are such that it will not take place with each and every party. Each and every party's car will not get stolen. Each and every party's car will not get damaged. It's only a probability which insurance company expects. It's only a percentage which insurance company expects on day one, in respect of which such claim may be required to be paid. And accordingly, the amount of this premium is decided by the insurance company. And therefore, the insurance company, even though it will be required to pay such a huge amount, still would be making profits out of this arrangement. Okay, yeah. So this was briefly about the business model, the way this really works. And as we have all understood that for the purposes of our audit, it's very, very important to have a business understanding, and of course various regulatory requirements around it. And this company, because in these companies, again, the public interest is substantial because the public is involved at large. So that's why these companies are also highly regulated. They also operate in a very regulated environment, because of which auditors requirement increases significantly. And all of those aspects we'll discuss in the next session. All right. Yeah. So with this, we will end our discussion over here. In the next session, we will start our audit procedures, understanding of various legal requirements in relation to the insurance companies. Okay. So thanks to all of you for your time and for your wonderful participation today. Thanks so much.